Welcome to episode 11.
Nice.
There's something called DeFi, stands for decentralized finance, and that's going to be the topic of today's video. It's probably like the biggest sector in crypto. Throughout the series, we've actually used many DeFi sites like Jupiter, Drift, but we haven't properly looked into it, and that's what we're going to go through today. I got 6 sections for today's video.
Yeah.
But the first 2, DEXs and liquidity pools, we've already covered over and over again in the series. So if you're watching this and you don't know what a DEX or a liquidity pool is, either look at the written guide or go back and watch our earlier episodes. So the first thing we're going to start with is yield-bearing assets, or YBAs. We like an acronym.
Yeah. Can tell.
Okay, so yield-bearing assets. As the name suggests, these are assets that generate their own yield. We've already used YBAs without knowing it. The first one was liquid staking tokens, so Infinity is one.
Yeah.
Because you earn SOL rewards over time. JLP, because you're earning fees from lending out liquidity to people wanting to use leverage. And the last thing is liquidity providing tokens, where we've been doing liquidity providing.
Yeah.
Yield-bearing assets are important for 3 reasons, really. First one is they provide DeFi with more yield opportunities.
Oh yeah. They're kind of considered pretty secure as well within crypto.
Yeah, I guess. JLP's been around for a year and a half, so it's in crypto age, it's quite mature, really. The second reason is they perform sort of specific functions. So JLP is deepening liquidity for those traders on Jupiter. The other example for that is LSTs. They're helping secure the Solana network. Third reason is they give rise to more advanced trading strategies. So because they're kind of unique, you can take it a layer above and use those as the underlying for other strategies. We'll talk about that last. The next thing we're going to talk about is real world assets, or its acronym form, RWAs. And basically what it is, you can put stocks, bonds, other existing financial instruments on chain as a token. Basically, taking something that exists in the real world and tokenizing it.
It's just a vehicle to tokenize assets.
Yeah. And
real world assets.
Yeah, it's just something that existed already, but in a different place, and that place is blockchain.
Yeah.
RWAs are good for a number of reasons. The first one is accessibility. Before this, it's quite hard for the average investor to get access to investment opportunities, because often those are reserved for people that have a lot of money and they can take a bit more risk. With RWAs, it lets everyone have a go and gives you opportunities that you might not have had otherwise. So it's fairer.
Let's say I wanted to buy a townhouse in London. I can never even have the opportunity to see what it's like to do it because I just don't have the initial funds to make an investment.
Yeah.
But with this, it's you get shared out, so small net worth individuals can kind of dip their toes in bigger pools.
Construction company looking to raise for a new project, and before they might have only taken 100 grand as an investment, but now if you've got $100, maybe you can still earn the same returns, but just with a smaller amount of money.
Right.
The second reason is efficiency. Remember back to actually the first episode when we were talking about blockchain, I was saying that most banks, to settle a transaction, 2 days after it's been made, that it settles.
Yeah.
Whereas on Solana, it's about 2 seconds to settlement time.
Right.
Saving a tremendous amount of time and effort and jobs.
Yeah.
So it's way more efficient. If they bring more stocks on chain, you can have 24/7 trading. Why should it only be limited to 5 days a week?
Yeah, I like that.
Third reason is going back to yield-bearing assets. The ones that I mentioned as the examples, they're all crypto native. So their yield is dependent on activity in the crypto markets.
Right.
Whereas if you have a yield-bearing asset that's also a real-world asset, you're taking yield from the real economy and putting it onto the blockchain. It's yield that's not tied to crypto markets.
Yeah, a bit more secure.
Yeah. Fourth reason is composability. So in the traditional market, you've got many different sub-markets for different stocks, bonds, etc. But if they're all on Solana's blockchain, for example, then they're all in one unified market. So you could trade between them very easily.
You can't do that with regular assets.
On the stock market, all that liquidity is segregated into different markets.
Yeah.
Whereas on Solana, for example, you could go from Solana into some random meme token.
Right.
All the liquidity is all available for everything.
Yeah.
So if you can tokenize real world assets, then you get access to all this liquidity and you can cross trade everything.
Okay.
You could have US government bonds, deposit them on an exchange and trade SOL with the collateral.
Like more opportunities. Yeah.
We're going to look at a quick case study for RWAs. A company's called Refi Hub, stands for Regenerative Finance. They're taking the idea about democratizing investment access, but for sustainable investments. Things like solar farms, EV charging, wind farms, etc. Someone will come along with an investment opportunity, they'll vet it, and then if it's good, they'll list it for their investor base. Then you can take your USDC, invest into these assets, and in return you get fractionalized investment tokens. And they'll take a solar farm, 100,000 people invest, and then it's broken down into each one's allocation, but just using tokens.
The tokens you have just represents like a percentage of the business you own.
Yeah. As that farm, for example, starts generating revenue, your allocation of revenue is given back to you and you just claim it USDC with your Solana wallet. Again, you're giving people access to an investment that they probably wouldn't have access to before, and it's fully on chain, and you can track how much revenue it's making, the yield, and I think it's a perfect example of the benefits that crypto and blockchain can bring.
Nice.
Moving real world assets on chain.
Finally, some coins with a bit of background value.
The next thing we're going to talk about is borrow-lend markets. In the traditional world, you have markets where you can get short-term loans and things. They're called money markets. And these also exist in DeFi, where you or I could lend out our money or take out a loan.
Crypto loan shacks.
So you're basically being the bank.
Yeah.
Instead of like operating in fiat currency, for example, in pounds, these money markets operate across hundreds of different tokens, meme tokens, you name it. The currency is not tied to a central bank who's setting the interest rates. How do you know like what interest rate you're going to pay to borrowers or lenders? And so we're going to have a little discussion about that now. The main way that people do it is something called the utilization rate. So let's say that there's 100,000 in the pool. There's $100,000 that people are lending out, and 80% of that is also being borrowed. Then the interest rate charged to borrowers is going to be very high, because there's not much liquidity left.
Right.
Those that are lending are also going to get high interest rate paid back to them. Similarly, if it was only 10% utilization, then it's going to be...
Borrowers pay low interest and lenders receive low interest.
Exactly. The more it's utilized, the higher interest rates for both borrowers and lenders, and the lower vice versa. Isn't
there so many pools you could borrow out of that has a low percentage of utilization?
Similar to the liquidity pools, arbitrage.
Right, yeah.
If there's many pools and you can borrow from cheap from one and deposit high in another, they just average out. So different to a central bank, with borrow and lend on DeFi, the interest rates are decided by market forces rather than a government, I guess.
Cool.
Okay, and the very last thing we're going to discuss are structured products. They're basically hedge funds on the blockchain. As DeFi's matured, these are becoming more and more popular. They're typically professionally run trading strategies. For example, the one we're going to look at is a company called Neutral Trade. And they're a group of quants and traders who used to work at Goldman Sachs.
Right.
And they're now running their own hedge fund on Solana.
It's like a normal hedge fund where you pay to have your money with them.
You pay a small fee. Usually they have a management fee and a profit fee. Performance fee.
Got it.
They're basically kind of like vaults. So anyone can deposit into there and your wallet never loses custody of the funds. It's just held in like an escrow on chain. And then they use your money to run trading strategies for you, and then you earn the yield.
Nice.
We're going to look at an example of one called JLP Delta Neutral. So JLP is made out of 5 assets, which we talked about last time: Bitcoin, Sol, ETH, USDC, and USDT. And the JLP token, it represents a share of that pool, share of those volatile assets. And when you hold JLP, you're exposed to the aggregate price of those assets. When Bitcoin, for example, tanks in price, so does JLP. I said last time that JLP has done well over time because it's earning a lot of fees. My question to you is, you want to hold JLP and you want to earn the yield from the fees, but you don't want exposure to the volatile assets. How do you think you do that?
So you want to only earn fees from JLP?
Yeah, you only want to earn fees. You don't want to be exposed to the index of the volatile assets. I'll be amazed if you get this fighting. I'm confident.
You like trade the opposite of what the JLP is doing yourself?
Kind of.
So you kind of like...
Warm.
You're like hedging yourself by betting the opposite.
Yeah, that's really close. It's called hedging. Let's say you're going to deposit into this strategy.
Yeah.
So you take USDC, you put it in here, then neutral trade, they'll take your USDC, swap it into JLP, so then it's like exposed to those 5 assets, or the 3 volatile ones being Bitcoin, Sol, and ETH. And then you take that JLP and you put it on an exchange like Drift, a perps exchange. Then, using that collateral, you open up a short position in ETH, Bitcoin, and Sol at the same value as what's in your same amount in the pool.
Yeah. Your initial investment would just do this, but your fees earned would go up.
Yeah, exactly. Let's say we had $500 worth of JLP. So theoretically, you'd have $100 worth of each asset if they were all equal deposits, but they might not be. Yeah. You don't mind about these changing in price because they're going to stick to $1.
Yeah.
But these 3 are going to be changing. You'd open up $100 short of Sol, $100 short of Bitcoin, and $100 short of ETH. You technically a long position because you're holding these indirectly through your JLP, but you've also got an equal amount in now short positions.
Yeah.
So it just completely cancels out.
Yeah.
So no matter what these do in price, it doesn't affect your holding in terms of its dollar amount. It's not going to change, but you'll still be earning the yield. And so in that way, you completely mitigate your exposure to volatile assets and just earn the JLP's yield.
Is it like a good yield? What kind of yield do you get with JLP?
Yeah, I think I checked just before, it was about 10%, and it's not even been going a year.
So it's just like, it's pretty much just guaranteed.
Let's say in the event that the USDC borrow rate increased more than the yield that you're earning from JLP and the delta neutral strategy, then you could result in a loss. But as long as you don't leverage up, there's not too much risk.
Right, nice.
But it doesn't stop there. You also earn yield from funding rates because we're using perp positions to short these.
Right. People holding long positions, not short positions. They're paying you all the time.
Exactly. And most of the time, like on average, markets are more long than short. And so over time, you earn funding rate fees.
Right.
So there's kind of 2 bits of yield for this strategy.
Nice.
Yeah.
I like that. You can do that with like, there's any other liquidity pools or not? There must be other big liquidity pools you can do that with, no?
Well, for example, you can do kind of the same thing, but with LSTs.
Right.
So let's say you had INF, you want the yield, but you don't want exposure to Sol. You buy Infinity, deposit, open up a short perp position with the equivalent Sol, and you just earn the yield. So we've looked at neutral trade as the example, but why are these structured products good for DeFi? First thing is, it shows that Solana's, like the financial place is maturing because you're getting some institutional adoption.
Institutional utilization. Decentralized finance.
We go, buzzwords. Another reason is that these strategies, like delta neutral, for example, traditionally it's only available to high net worth or institutional clients. But now you could just put $5 into here and earn the yield. You don't have to have huge amounts of money. So it's fairer. It's democratizing access. The last thing is it's much more transparent. These are all on public blockchain. You can see what everyone's doing. Let's say neutral trade strategy was underperforming, or this one specifically, you could go into another one of their strategies within like a few minutes.
Yeah.
It's not like you've got to wait weeks for them to give you back your money for you to change.
Yeah.
What do you think about this, and then what do you think about the whole video? Everything.
I think that's really cool because it's just kind of like just leveraging money in a really smart way I hadn't heard about before. So in a similar way to the RWAs, it's kind of allowing small net worth individuals to kind of make money work for them in a way that previously is usually open to high net worth individuals and companies.
Yeah.
Which I think is good. YBAs I like as well. I feel like there's a lot of ways to kind of earn yield in crypto that you just can't really do in everyday life, which is good. By like providing liquidity, providing funding. And the real world assets, I think that's like the future of crypto personally. As far as like onboarding people who aren't like interested in crypto right now, I think RWAs are like the key to the vault on that.
Would you agree that RWAs help to make crypto like more understandable?
Yeah, definitely.
Yeah. Of those 6 things, what's your favourite thing?
Structured products and RWAs. Probably.
So there we go.
Yeah.
Complicated stuff.
complicated stuff, but
if you watch all the episodes,
built on layers of less complicated stuff.
Yeah.
Yeah. Final episode is just kind of going to be us wrapping it up. So yeah, essentially.
Pete's thoughts on it all.
Yeah.
And
slating the market there.
And then we're also going to have a montage of our travel everywhere we've been, because we focus quite a lot on crypto, not much on our travel. So
yeah,
you'll get to see Asia.
Yeah, the most exciting shit is yet to come.
Nice.
All right.
Well done, Pete.